Hello, it's Mr. G, your business teacher. Welcome to the third video in our series on economic influences on business. Today, we're focusing on inflation, what it is, how it impacts demand for goods and services, and how it influences business decisions. Let's get started. Inflation refers to the rate at which the general level of prices for goods and services rises over time. In the UK, inflation is measured by the Consumer Price Index (CPI), which tracks the average price of everyday items like food, transport, and housing. When inflation rises, the purchasing power of money decreases, meaning consumers can buy less with the same amount of money. When inflation is high, the cost of living increases, making essentials more expensive. As a result, consumers may reduce spending on non-essential items such as holidays or luxury goods, leading to lower demand. Businesses may experience higher costs for raw materials, wages, and utilities, which squeeze profit margins and may force price increases. However, if prices rise too much, demand may fall, impacting revenue. When inflation is low, prices remain stable or rise slowly, meaning consumers feel more confident to spend money on goods and services. This can encourage spending on big-ticket items like cars and homes, benefiting businesses that depend on consumer spending. Businesses also find it easier to plan their costs and investments when inflation is predictable. For businesses, inflation impacts key decisions such as pricing, wages, and investment. High inflation may lead to wage increases to match rising living costs, resulting in higher operating expenses. It also creates uncertainty when planning for the future, making budgeting and investment more difficult. On the other hand, stable inflation allows businesses to plan long-term strategies with more confidence. Inflation also influences interest rates set by the Bank of England. When inflation is high, interest rates often rise to encourage saving and reduce spending, which can lower demand for goods and services. Conversely, when inflation is low, interest rates may fall to encourage borrowing and investment, boosting business activity. In your GCSE Business exam, you might be asked to explain how inflation affects business costs and consumer demand, analyze the impact of rising inflation on business strategies, or evaluate how a business can respond to inflationary pressures. Exam questions may present scenarios where businesses must adjust pricing or production strategies due to inflation. In summary, inflation affects consumer spending, business costs, and overall economic stability. Businesses need to monitor inflation closely and adjust their pricing, wages, and investment strategies to remain competitive. Thank you for listening to Mr. G. Please like this video, subscribe to our channel, and comment with your questions. I'll be happy to respond. See you in the next lesson on unemployment.